Hi guys, it's Abigail here again and welcome to my channel. So I did a video about regretting buying my first house and I had so many questions, and one of the questions I kept getting in the comments was why I said that I may have considered buying my property in a limited liability company and how beneficial that was going to be to me. So I'm going to do a deep dive about the questions, what to consider when buying a property and considering buying it in a limited liability company, why people do it, whether you should do it, and the pros and cons that you should be mindful of before going down that line. So let's dive right into it. So the first thing to be mindful of is before 2015, in the UK, several people had more than one properties, and you have these landlords who own a property they live in, then they own another property they rent out, and for their buy-to-let properties, they would usually go in for a mortgage, and majority of the time, the mortgages are interest-only mortgages. So let's assume you have a mortgage for 100,000 worth house that you bought as a landlord and your interest rate was 7%. So we're just using some figures here so you can understand the concept. That means that you pay 7,000 a year in interest on the mortgage. In this case, if you're renting the house out for £10,000 a year, you can take that 7,000 out as a deductible cost before you pay tax on the 3,000 that's left as your profit, assuming there's no other cost that you incurred in having the house to rent out. So this was great because people can get a mortgage and then they put down a down payment and they can rent it out and make some profit off of it. Now, an act was passed, and I'm going to read it out to you. So Section 24 of the Finance Act 2015 restricted tax relief on mortgage interest for landlords, meaning they can no longer deduct the full amount of finance costs, including mortgage interest, from their rental income before calculating their tax liability. So this was the act or law that was passed that shook landlords, because now let's assume that you are making £10,000 in your rental on your £100,000 worth house, and the amount of interest that you are paying on your mortgage is this £7,000 I mentioned, which was maybe 7%. In this case, if you are a higher tax-paying individual, so maybe you earn 50,000 and above, you'll already be paying taxes of about 40%. And in this case, you would have the 10,000 of the income that you are earning from your rental added to your 50,000 salary or income from elsewhere, meaning now you make 60,000 a year. You will be taxed on that. So you probably pay about 40% of that before you can now come and deduct your 7,000 that you are paying in your interest on mortgage. So now most of the landlords realized that they were making losses instead of making any profit at all from their properties. So some sold. So since then, everyone has been advising to buy your properties in a limited liability company, which is mainly properties that you want to rent out. Because if you buy a property in a limited liability company, you are able to remove the finance costs, which in this case is the mortgage of 7,000 a year, if we are using the same example, and now you earn your 3,000 profit as corporation profit or profits from your business, then you can now have that as profit and you can pay yourself in whatever way that you want to pay yourself. So now everybody who wanted to build a portfolio of rental properties started going through limited liability companies. Now I'm going to take you through things you should be mindful of when you are thinking of buying your property, especially your first one or your second one or whatever, in a limited liability company. First thing is you need to ask yourself why. Because if your idea is to live in the house, and that is a house you want to live in forever, so it's going to be maybe a 4-bedroom house, a 5-bedroom house, a 3-bedroom house, you're going to live there with your family, the motivation for buying in a limited liability company is probably lower, because you're going to be paying your own mortgage. It's in your name, you're going to be living there. But if your situation is, oh, I want to buy a smaller flat, a smaller place, a smaller house, and then when I have more kids or when we outgrow the place, I would leave, buy a bigger one, and rent out that one, then it may seem suitable to buy your property in a limited liability company. But one question I want you to ask yourself is, are you even planning on building a property portfolio? Is that what you're looking to do? Is that the idea of what you want to do for the future? If so, is it worth creating a whole limited liability company and putting your property through that limited liability company? Thankfully, I've gone through this process before, so I've got some experience, and I'll share with you the pros and cons that nobody tells you on this internet until you find yourself in that situation. So first of all, you have to decide how the ownership structure is going to be for the company. If it's for you and your husband, are you going to share 50-50 shareholdership? And that's how you create the company. So you'd go to company's house and create a new company. You get letters from HMRC that you are now a new company. You will probably be the director of the company, and you are in charge of all the filing, all the paperwork, all the regulatory stuff that come with a company. So now you are literally telling HMRC that you own a company and you are operating, and therefore every year you need to file your taxes as a corporate. So one thing that happens is when you have a limited liability company and you're buying a house through it, usually the solicitor fees or the legal fees are higher than if you're buying it in your own name. So let's say solicitor fees like $1,500 for buying your own name. You usually see the quotes coming out for a limited liability company about £2,000. Now, I'm not a lawyer or a solicitor, so please do your research around that. Comb the market to find the best rates for yourself and the people that could act in your best interest before you go ahead with them as solicitors. Now, the next thing is, for most mortgage lenders, when you are buying a rental property in a limited liability company, they will only loan you 75% loan to value or even less, depending on the situation. So in this case, you need to put down 25% down payment of the house before you can get a mortgage for 75% of the house. But let's say you were buying it in your own name. Some mortgage lenders will allow you to loan up to 90% loan to value. I think there were some points in time where you could even loan 95% loan to value. So in this case, if the house is 100,000, that means that you need to bring 25,000 and you can loan 75,000. But if you're buying in your own name, you probably may have the option, depending on your financial situation, to bring a down payment of about 10,000, of about 15,000, and you'll be able to get the mortgage for the rest. Obviously, you'll be taking through the checks to make sure that you can afford the mortgage, whether in a limited liability company or in your own name. Majority of the time, when you're buying it in a limited liability company as a rental, the bank or the mortgage lender will do something called a stress test. And so they will check to see that if interest rates or things get difficult, so let's say the rates that they're giving you is around 5%, but they will have a stress test figure of a rate, which is, if interest rates get to this level, will your rental income be able to cover the mortgage? And if not, they might probably ask you to supplement in terms of you giving some personal guarantee that you will top up the mortgage payments in case the rent is not enough to pay for the mortgage every month. So you need to be mindful of that, even though it's in a limited liability company. The next thing you need to be aware of is that you somewhat lose your first time buyer rights when you buy in a limited liability company. So let's assume that you're even buying this property and it's your first property, but because you've decided to buy it in a limited liability company, you are not going to get the stamp duty of up to 250,000 of the house being zero. You will probably pay stamp duty as if it's your second house. So it's going to be calculated from zero value all the way to whatever value of the house you're trying to buy. So you have to do the calculation on the government website, or there's some apps that help you calculate the stamp duty, but you're going to be charged the higher end and not the lower end. So the first time buyer rights, or the first time buyer is the one that gets those reliefs. But if you're not a first time buyer or you're a limited liability company, you are not going to get the reliefs on your stamp duty. You're going to pay all of it. The next thing is, especially when it's a new company or a company that doesn't have a lot of rental properties, the mortgage lenders will usually ask you to give a personal guarantee. And I came to understand that they would ask that if for some reason this new company you've created is not able to pay the loan or keep up payments, you, the director of the company, which will usually be the case, are liable to use your own money to pay. And then they would ask that you get independent legal advice concerning signing a personal guarantee in this regard. So in this case, your solicitor who's acting on your behalf would ask you to go and find another solicitor who you will pay money to now advise you on the personal guarantee that you are signing as a director of a company, that if the company is not able to keep up payments, the mortgage lender will come for your money, your personal money, which usually is not the case, because a limited liability company means that the liabilities of the company are limited to the company and not individuals in the company. But because of this new arrangement where various individuals are just buying houses in limited liability companies, the mortgage lenders are going to the extent of making the directors of these companies, usually just yourself or you and your partner, directly accountable to these loans you're getting, because the company will not have a track record for them to say, oh, we can see that the company has money and therefore can keep up payments. And so they are trying to protect themselves so that their money is not loaned out to you and they are not able to get it back down the line if they need to get it back, or payments cannot be kept up. Now, another point to note is, majority of the time, when you buy in a limited liability company or you are getting a buy-to-let mortgage, most people just go in for interest-only mortgage. So the interest is, if you calculate it in that way, might be slightly lower. I mean, the outgoings every month from the property or to pay the mortgage is usually slightly lower compared to when you have a residential mortgage, which is amortized. So in that case, anytime you make a payment, it's baked in for you to pay some principal and some of the interest. So therefore, it might look like your outgoings for the mortgage is lower in a limited liability company, but you should know that you are not reducing the initial principal, which was 75% of the loan. You are probably keeping that. It's maintaining its value until you decide to pay off some of the principal. So please be mindful of that. The next thing is, now that you've bought that property in a limited liability company, let's say you want to live there. So your idea is you're going to live there for about 2 to 3 years, and then when you have enough money or you want a bigger house, you just hop out of the house, rent it out easily, and then you'll be able to buy a new one. But you need to check whether the paperwork with the mortgage lender allows you to rent the property to yourself, because sometimes there are some restrictions to rent the property to yourself or even family members. I think maybe due to conflict of interest, but I'm not 100% sure. So just check in the paperwork that you can rent it to yourself. And also, it will not be allowed for you to rent it to yourself at a cheaper price than the going market rate. And your accountant is probably going to ensure that that's what's going to happen, because that feeds into my next point of you need to have an accountant. Now, because you created a limited liability company, you now need to file your tax filings every year. And you cannot do that on your own unless you're an accountant. So you need an accountant to help keep your books, because you now run a good company and you're going to be filing your taxes every year. And the accountants don't come free or cheap. So now you need to bake in that cost into your limited liability company and the cost of having a property in that structure. And also you need to be highly responsible for all the accounts that you give to HMRC. If something goes wrong, HMRC will come after you because you are running the company. You are the director. You are fully responsible for the company. Now, the next point you need to be mindful of is, okay, let's assume you've bought the 100,000 house, you put down 75%, and the interest you pay on it every year is, let's say, £4,000, right? And you manage to rent it out, maybe to yourself, maybe to somebody else, for £8,000 a year. That means you're making £4,000 profit. Let's assume as well that there's no other cost apart from your mortgage interest payments. So 4,000 is clean profit. Now that you've gotten the clean profit, how do you pay yourself? Because you can't just pick the money from the company and spend it as your income because you think it's your profits. So before even you can pay yourself, the company will need to pay corporation tax. So you need to account for corporation tax going out on profits you've made in the company. Let's say that you're saying, oh, you pay yourself a salary as a director of the company. Mind you that the director needs to pay NI and tax, income tax on that particular salary that's coming out. So if you have a job elsewhere, which is paying you a salary and now you're getting additional salary from this company you've created, it's going to top up. And you're going to tax all your gross income at the rates that you are paying taxes. So if you're at 20K a year, and that's all your gross income, including the property, maybe you wouldn't pay as much taxes as if you're at 100K a year. So it's a very personal decision. You need to look at your life. You need to look at forecast your future. So let's say you're in a job where you can see yourself getting promoted in the next 5 years and your salary is going to go from 20K to 40K to 60K, and you will be hitting higher tax paying levels soon. You need to be mindful that if you're going to be giving yourself salary from your own company as your form of income, you are going to also be paying taxes on that. The other way by which people pay themselves is to give themselves dividends. Dividends also do not come free, they come through taxes. So you would pay some taxes on the dividends before you can take it out of the company. So one thing you need to do is you need to sit down, do all the costings that I've mentioned, find the numbers to it, put the property you're looking at together and say, okay, am I actually making money, or am I making the most money by buying it in my name or buying it in a limited liability company? Because sometimes, let's say somebody's got a wife or a husband who's not actively in a job, so they don't have a salary, and they can buy the property in the name of their wife, who maybe has 12K tax-free income. And if the income they are getting from the property is less than 12K, that means that they can comfortably pay no tax because it's tax-free income, and then remove their mortgage and enjoy the rest as their income or as their profits without having to pay additional taxes to nobody. But in this case, if you went through the whole process of buying it through a limited liability company, you are paying people so much throughout, and by the end of you paying all that money out, you realize that your profits have significantly reduced. So you need to analyze your own situation before you go ahead to say, oh, I'm going to buy that property in a limited liability company, because it might get to a point maybe you can't run that company anymore. You probably have to sell the property, or you are thinking of what are the next steps. Might be difficult making decisions in the company compared to making decisions in your own name. Now, one of the last reasons why people are considering buying property in their name or in a company, which either one works for you. So in a company, it's assumed depending on how you work it out, that it's easy for you to give ownership or let your children inherit the property or inherit shareholding in the company, or you can put in maybe a fund or a trust fund, and then your children can inherit it without being hit with a huge inheritance tax. Now, I want to sound a warning here. Everyone should do their research thoroughly. Speak to a financial advisor concerning properties you're buying and how you want to pass it on to your children. Because normally, if you pass a property on to your children, and let's say you fully even paid for the property, your children are supposed to pay inheritance tax, which is 40%. Majority of the time, the children do not have that amount of money when it's time to pay the inheritance tax. So they end up selling the property to be able to pay the inheritance tax. And this is putting a lot of people off. So they're finding other ways, which is buying through a company, having a trust fund or something of the sort to make the inheritance tax more bearable for their children, even if there's one at all. So these are the things you should think of. Sit down, put pen to paper, have an Excel sheet, put all these costings together and make the decision for yourself with your future plans, whether it's best for you to buy a property in a limited liability company or buy a property in your own name. Thank you.